In this video, traders, we're going to look at trading mean reversion intraday. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. Alright, so mean reversion intraday. I'm looking at the SPY. We're coming up to the last 30 minutes actually of trade. I've got a couple of stock positions on that I'm just monitoring before I leave. And I was looking at this S&P 500 or SPY, which is the ETF for the S&P 500. And you know, for transparency, guys, I'm not trading the SPY specifically today, but I thought this is just a textbook mean reversion type day. Great opportunity for me to potentially talk about some ways that if I was choosing to get involved in it, some of the tools that you can use. And so maybe one of you can take one or two ideas away and kind of integrate it into your own trading. So like I said, I'm not trading today, so it's not me saying, hey, as well, I was trading it, other positions on. But I'm not opposed to trading a mean reversion day from time to time. Prefer a bit more of a range expansion, momentum ignition type scenario, if I'm honest. However, you know, when the conditions are right, you can be knocking these singles back and forth and making some good trades, some scalps and some day trades. So first things, this is the S&P 500 ETF SPY. If you're trading the S&P via, say, our channel sponsor via a spread bit or CFD, you can check them out, guys, in the description below. That would be, you know, the S&P 500 or the US 500, I think is what they call it, or the Dow or the Nasdaq. This happens to be, the Nasdaq's a bit of a different shape actually today. But anyway, you've got this scenario where if you can have access to the VWAP, I know that you can't on some platforms, but TradingView does, and you know, many of others do. That gives you a good guide as to, you know, how far the rotations are going away from the VWAP and back and forth, and we're just rotating around the VWAP. But I recognize it's not something everyone wants to know about that. But a lot of you are trading from indicators and just pure price support and resistance. The obvious one is, and we've got to be careful, guys, we're not using hindsight bias here. Bearing in mind, last 30 minutes of the day, you know, you've got to be careful. But bracketing it with a standard kind of high or low, or a level on a high or low, is a great way to do it. And mean reversion being that you're fading any potential breaks to the high or low. And just bearing in mind, you know, if you're in the final kind of 30 minutes to 45 minutes, then don't be trading mean reversion. Just be, I mean, there's two schools of thought. One school of thought is the likelihood is, guys, that we close right on the VWAP today, because it's been oscillating around, the algo has been pulling it back and forth, We're going to probably have a VWAP close. So, you know, but the only thing you've got to be careful of is be careful if the volume starts picking up and you start holding outside of the kind of prior low or prior high, then be careful. If you're coming back into it, then by all means. Anyway, I'm jumping the gun a bit. You can bracket your kind of first hour or two high and low, and anytime you get close to that, you're pulling the trigger for a move back to the midpoint. So if you haven't got your VWAP at all, you can have your midpoint put in. And that's just not viable, guys. You can do it far more professionally than that. And literally trading, selling when we approach the early morning high again, and then covering when you come back to the midpoint. Buying when you reach the early morning low, covering when you come back to the midpoint, etc., etc. Now, that's hindsight, but that works well. And what you kind of trying to do there is give yourself a little bit of a room and say, okay, what's half of the distance between my target, which is the kind of midpoint, and the low, you know, so when you're taking the trade, and when you go, okay, what's the half the distance, and you go, right, where does that sit? That probably sits about there. So that's when you'd put your stop. So if you're trading that, say you do stop, so you've still got a reasonable risk reward ratio. Anyway, some of the other indicators that you can use, let's clear some of this stuff off, are Bollinger Bands, are Keltner channels. Why? Because they're both mean reversion type indicators. Keltner channels is made with ATRs, average true ranges. Bollinger Bands is more standard deviation. So this is when they really come into their own. Once you've seen, and bear in mind, guys, you know, you don't know, and it's your job as a trader to, as quickly as possible, identify the day type. But once you start oscillating in mean reversion, you know, by about a couple of hours in, you really got to go, you know what, we're mean reverting, I might have 2 or 3 trades out of this. So then you start to kind of use mean reverting tools, whether you're using the high and low framing method, or whether you're going, okay, well, I've got a Bollinger Band, let me stick a Bollinger Band on. Now, this happens to be a 20 period and 2 period setting. I like that. It's a nice standard approach. It's a 20 period moving average. I've got a 3-minute chart on here. It's going to be similar whether you're on a 5-minute, etc. Don't go too narrow, but it's going to be very, very similar. You can get more signals. but it's going to frame price, and when it pops out of that reference point, it's going to signal a trade. And you want the moving average to generally be reasonably flat, and the lower time frame you go, the more the mean of the moving average is going to be much more jagged. So the idea of this is that every poke above or below your Bollinger Band, you take a counter trend trade. So as it pokes below, you go long. As it pokes below, you probably want to take this first one, if I'm honest, because you're still not sure of its mean reversion. After that, very good, you're all game. Pokes below, you take the long, you close as it comes back in, you've got a nice scalp. Or those of you who are feeling a little bit more aggressive might hold it for a touch of the upper body. And then the same thing from the upper side, you take the short as it breaks the upper body back again. You get a little trade. You've got a few trades here, as you can see, guys. You've got a long here, you've got a short, you've got a long here, you've got a short here, you've got a long here. You probably stopped out on that one. If you're being brutally honest with yourself, you've probably taken that. You might have seen a bit of it go your way. Didn't quite hit the mean there. Depending on how you've managed it, of course, but you may well be stopped out. But anyway, that's one way of doing it, Bollinger Bands. The disadvantage with Bollinger Bands, as we talked about before, is the way they can expand and contract. And so when the price has been doing not a lot, and let's put it back on here, they start to contract like this point here where price not doing much. Look how the standard deviation really starts to contract. And so when you're trading this, be mindful that when they're contracting, don't just dive in when it spikes above it. Wait until the price comes back into the band, if that makes sense. So rather than you kind of selling immediately as it comes, especially when they're starting to contract a bit relative to prior width of the Bollinger Band, as the price starts to go through it, wait until it comes back into it. Let the Bollinger Band expand a bit, because otherwise you're going to be trading it way too early. You're taking all these kind of things and the Bollinger Bands are narrowing. So be careful about that, something to be mindful of. And trading as it comes back into the band is a better way. You might miss a few, but it's a little bit safer. It stops you getting ripped your face clean off if you're kind of shorting a big push up. Keltner channels, I slightly prefer these. I have them set on a 20 and 2, based around average true range. A little bit smoother, less kind of prone to expansion and contraction like the standard deviation of the Bollinger Band. Same kind of thing applies, guys. As it approaches the upper Keltner, you're taking the trade. Upper Keltner, you're taking the trade. Lower Keltner, you either took that and got stopped out or you didn't. But the point is, it's framing price. And if you kind of go to a 5-minute chart, you can see how it's very, very similar, but slightly less signals. You've probably got one signal there. If you go down to a 1-minute chart, you're going to get much more signals, and you probably want to have it wider in that case. There's nothing wrong with using this if you're a very active scalper. I think fine, as it comes back in. Again, always better to as it comes back in, when you're getting more noise, more signals, rather than taking the first break out of the outside band, take it as it comes back in. There's scalping opportunities there. There's no doubt about that. But you've got to be a little bit more mindful about how you manage risk. You might get a little bit frustrated because you take some, they eventually work. Just you understand the game, guys. As soon as you start to go down the time frames a bit, your signal ratio goes high, and then you obviously can get a lot of noise as well. Signal ratio to noise ratio just goes crazy. So 3 minutes I think is the sweet spot. So that's really kind of what I wanted to share with you this video, guys. As we come up to the close here, I'm going to see what I've got and see where some of the positions are, to hold them overnight. Done some videos I talked about, actually 1 or 2 of those, so check them out. But yeah, just sort of a mean reversion type environment. I thought trading this back and forth, it sort of caught my eye. I just thought, hey, you know what? Let's share some ideas on ways to perhaps structure your trading day if you're into day trading, mean reversion on a relatively range bound environment. And guys, take care, keep your risk managed, whatever you do. And I don't say that lightly, because in the context of this, you could just break out and run. So you don't want to be undoing, taking 2 or 3 nice little single trades, putting some cash in the bank, then giving it all away because something just explodes and you get stopped out. So be prepared to take a loss, keep it manageable, and if it comes back in, it is what it is. But at least if you're focused on that, and it saves you wiping out the kind of real range expansion move. Anyways, take care, see you next one, bye bye.